We're going to take a look at the ES and quick pass through euro dollar and cable in the dollar index. We'll take a look at NASDAQ. We'll take a look at the Dow futures, and we'll peek at gold. Okay, so that's what's on tap for this morning. I'm going to talk a little bit about where setups form, how you can trust the principles I'm teaching, but we're going to watch CPI live. So let's take a quick look at, let's start with the dollar index. Okay, and let's make sure we're on the weekly chart. And we're at the bottom of that gap in here. Let me zoom in. There's a whole lot of annotations in here from our recent discussions pertaining to dollar. So this gap in here, originally we treated that as an inversion gap. Come down and act as support to take us up into our premium arrays. We have since worked lower back inside this gap, and I mentioned in the last commentary that I want to see if it wants to go outside of this and then treat this shaded area here as resistance. Okay, so far we've came down and we respected the low of it. I'll drop down into a daily. I'll try to get through this pretty quick because I only have a few minutes before CPI comes out. Okay, so we have somewhat of a small little remaining gap here with an order block. So I'm going to note that here. So I'll be watching that going into the rest of this week. I don't like the color. It does not mean, okay, does not mean for you to go in here and assume that dollar's going to sell off right away because ICT is putting it there. I want to see if CPI supports this idea. So that's why I tell you don't stand ahead or get in front of the CPI number, because it can be very one-sided. It could smoke you easily. Your stop loss will not protect you. But I want to see if it wants to get below this, then treat this as resistance and start to gravitate towards this. I'm not suggesting it will do it all in one fell swoop today. Obviously, it can do that because this is the type of market driver that can create those types of runs. But I want to see, does it want to get down into here and then reprice to this inefficiency between this candle's high and this candle's low. More specifically, the opening price of this down close candle on the daily chart. And let's go over to euro. All right, in similar fashion, we have a bearish order block here. Very small little gap here. I'm going to show you the two levels so you can see there's a separation. It's not much, but it's there. Okay, so this order block. So reaching up into this down close candle's range, repricing to the separation between these two candles. So this candle beneath my cursor, that candle's low, and this candle's high. Okay, the candle right above my cursor, that candle's high. Okay, that small little inefficiency. I want to see, does CPI lend well to it wanting to get up into that area. There's a small little pool of liquidity in the form of buy stops that will be resting above this. And when the market has moved away from this gap here, we traded above the short-term high here, relative equal highs. So I want to see, does it have a willingness to use the CPI number to expand into this direction. Now, if we take out this low here and, very specific, get below the consequent encroachment of this wick. Why this one? Because the difference between the candles open and close on this one inside of the gap, this one over here, it left that fair value gap here. There was a change in the state of delivery right there. So if we get through the consequent encroachment of this wick, that to me spells bearishness on euro dollar. and dollar might surprise to the upside. But as long as that does not happen, I'm looking for this order block in this gap. So that's what I'm looking for. I favor this right now, so that way you understand what's going on. But if I'm wrong, where do I concede and say I'm wrong? And then I look at the market from the opposite end. As I mentioned, it needs to get below the consequent correction of this wick, because that's where the state of delivery changed inside this gap and started seeing us run higher. We've taken a pool of liquidity out here, and we went a little bit higher, but these are relative equal highs. So I don't know if they're using that right there, and then CPI sinks us, and they make aggressive runs for the sell side below here. I don't know. So it's important for you to understand that there are times where your analysis, your experience, your model will be silent. So that's the two things I'm looking for fiber. Take a quick peek at cable. All right, cable, I believe, this is nice. Came down inside this buy side imbalance, sell side inefficiency, which is a fair value gap, but it's in a buy side imbalance, sell side inefficiency. It trades down to it here, and then look at the reaction so far today. So I want to see us return back up into this gap. I'll show you in a second where that's anchored. It's on a weekly chart. I apologize. Let me go back up to that. So that's that inefficiency right there. So I want to see, does it return back into that? If it does, it has unfinished business all in here. And that's assuming, obviously, if the dollar falls off. Let's go back into a daily. So far, really, cable's been just hanging around this large consolidation. Not a whole lot of activity. Even though we came down into this gap, traded into it and showed an initial willingness to want to go higher, we have to overcome this. Okay, so let's show that in perspective. So it's going to have to make a real meaningful move outside of that range here. I'm keeping it faint like that. You might want to use a darker color, but the real level I'm trying to be interested in is here. So if we trade above it, fall short, and come back down to middle of this inefficiency, that would be consequent encroachment in the form of potential support. So if we run up, fail to get to here, that shaded area, like run above and come back down, the lower time frames might give us an idea after CPI. That would be something I would look for. It's not a trade idea. It's just something I'm running in terms of scenarios. What do I look for? What would I wait for after CPI? If you don't trade ahead of CPI, ICT, what are you looking for after CPI? What are those types of things? It's these things here I'm trying to outline to you. And let's take a quick look at NQ. We are looking at the September delivery contract month now. It's symbol U. So NQU 2023. All right, so here is the, let's go to a weekly chart. Here is the weekly view on NQ. And like I said, this was the outperformer on the upside, the strongest one, and it has delivered so. And drop down to a daily. All right, this one here. Only experience speaking here, okay? Because we have a rate announcement, FOMC related afternoon tomorrow on Wednesday, and we have the CPI number this morning, which will be out in about 4 minutes or so, a little less than 4 minutes. I gotta hurry up. This sell side looks suspect. Even though we had a really nice run up in here, I just feel like they're gonna make an attempt to get into this week. Will it be today or tomorrow? I don't know. But this looks too clean, way, way, way too clean. And even if it went down there, that would upset folks thinking that it's topped. And then to me, if it went down below that and rallied and created another short-term inefficiency, that would be bullish. That could continue going higher. This would upset those individuals that see this as support or a real good area to trail stop losses below that. ES real quick. I don't see the same thing there, but if NQ draws down there, the S&P would want to follow suit. I'm not trying to pick the top. I'm just saying CPI, I look at that number that comes out as a means of trying to smash anyone that's profitable. It can, in some instances, be used to continue or capitulate a move. That means something that's already in a movement like this, it could accelerate and add the last piece of it. So again, that's the reason why I'm not getting ahead of it and trying to trade. And then the Dow. This one here, I favor a run above this high here. I think that would be something to expect because it's been the sixth sister of all three indices. NASDAQ, I told you, would be the leader. Our focus has been teaching through the price delivery of E-mini S&P. And the Dow, I use it as a barometer, like I use the dollar index. I don't trade the dollar index, but I use it as a risk on, risk off for comparative studies and relative strength studies for the indices. I use the Dow. So for like Dow theory, SMT divergences, six sister concepts, those types of things, I lean on the Dow for that purpose. We have a little bit of an inefficiency rate in here, so we could, if we're going to drop initially on CPI, it could go down there and then make a run up into that. That would be a scenario I would watch and see if it manifests today. It is not a trade idea, so please don't take that as such. So let's quickly go back into ES. We'll drop into a lower time frame. Oops, I owed you gold. Sorry, real quick. Let me see if I can pull it up. Gold. I don't know. There you go. Gun to my head, I would say it's going to run with the sell side below here. There you go. That's what I think. I'm probably wrong. Please don't trade it, okay? But I wouldn't touch this at all. All right, ES, let's drop down to a 15-minute time frame. Small little gap in here. Buy side rests above here. So 30 seconds or so. Everybody that's in a trade is going to regret having been in it. And everybody that gets lucky or post it on social media and offer signals for purchase. So here's where our sell side is. I'm going to try to keep the annotations light, just focus on my viewpoints. Sell side's here, buy side here, inefficiency resides rate. If I can get down here before it pops off. So it ran up and hit our fair value gap I was talking about. Ran through it a little bit, that's okay. Which is mean threshold of here. Then swept the sell side. Now buy side's next. All right, let's take a quick look at NASDAQ. So it's taken its sell side here, then ran for buy side. Dow, we're at 15-minute time frame. Let's take a quick look at the daily on the Dow. Yeah, I like this high. So whenever I have a wick like this, I'll measure the midpoint, which is consequent encroachment. That would be first objective, and then I want to see if it wants to get above here. I could be wrong because it may use this initial pump to fade into that, and then tomorrow's rate announcement do something completely opposed to what I've outlined and not even come up here. But I think that this is a likely draw on Dow. Right, and let's get back into a 15-minute time frame. So we've had buy side here and sell side taken. The initial draw, let's go into a 1-minute chart. All in one moment, in 1 minute, the market opened here, ran up just a little bit above the fair value gap, then slammed down to take sell side, and then in the same minute, one candle close up here after running up the buy side. So in 1 minute, look how much the market has traversed. This is literally a 50-50 now because it's taken both sides of the liquidity I drew your attention to, working off the fair value gap I mentioned first. Now, the takeaway in this is I want you to think about how we were looking at the buy side and the sell side. Forget right. Forget being wrong. Forget profitability. Think. Okay? Think about this. All of the movement that took place thus far was all inside of a 1-minute basis or 2 minutes. That's it. So all of this movement from here and here that happened in a blink of an eye. You would not have the ability, if you didn't have limit orders in that could be filled, not that they would be, you wouldn't have the ability to adjust or to comprehend what it is that you should be doing next, especially if you're a new student or a new trader. You have no idea what you're doing. You have no idea to where you would measure a willingness to see continuation up or down. Maybe you didn't even know where these pools of liquidity were before I mentioned them. So if you don't know those things, why would you even gamble on this report that's coming out, or that came out 6 minutes or so ago? It's important not to see these things and see how much it moved and think to yourself, if I would have got a piece of that. That's not that kind of move. Okay, that's not what this is. This is a trap. This is a very difficult thing to convey to new traders or new students, because they think somebody absolutely bought the low down here or in this area and then sold it up here. They believe that. And I'm telling you, that didn't happen. If it happened, they'll gladly go into their broker account and log in live, log into it with their password blocked out. That's fine. But go in there and show their time and date and their time and sales fills on a reputable broker. You're not going to see that. Okay. Believe me, folks, if I could do that in this report, I would be doing it every month. Every time it would do it, I would do that just to show you, this is the way it is. But I'm telling you up front, because I want to protect you, that this type of market driver is essentially risking ruin. But we can identify and use it, like I teach to use the non-farm payroll. Okay, non-farm payroll, I don't trade that report. You can trade after the non-farm payroll report. You can trade after the CPI number. But ahead of it, no. Because you have no idea. You have no idea. I have no idea where it's going to go on the CPI number. So what makes you think you do as a greenhorn? Someone that just started a couple months watching some videos from some Yahoo that teaches with a demo account. You think you're going to be able to beat this? No. Don't do that. You're going to create scar tissue. So what I did this morning, I outlined how to focus on what to look for and what you would study. And in a minute or less, drew out, here's where the buy side is. Why did I call this out? Look at the idea of it not wanting to go higher. So retail sees this as what? Strong resistance. So they can be short in their mind. And the stop losses would be above these highs here in the form of buy stops. That's what we call buy side liquidity. I took you over here to the relative equal lows. What's going to be resting below that? Sell stops, which is why we call that sell side liquidity. Both sides of the marketplace are always in contention for high impact news drivers like CPI, rate announcements, non-farm payroll, those types of things. Anytime you see in your lower time frame charts these smooth edges like this, very, very smooth relative equal lows, very, very smooth relative equal highs, they are going to be made jagged, meaning it's going to rip through it like it does over here. So now they're not so smooth already now. This whole movement down here was a function to offset any positions or interest, because it controls sentiment as well, with orders resting below here. Down here. I'm sorry, up here rather. Down here. Where to go? Looking at the relative equal highs, the market ran for those as well. And then what has it done since? It's staying in between those two pools of liquidity. But what did it do first? It went right to the fair value gap I mentioned, overshot it by a little bit, which is understandable given the nature of this report that came out. And then inside of all this move, it dropped down. Now you can't see it like this. So if I'm in a 1 minute chart, here's the 8:30 candle. It opens, trades up, and it looks like it completely rolls right on through it. But we saw momentarily before it ran up higher, it ran up to it here and stopped. Right in here it stopped. And then moved lower. Then came all the way back up and overlapped the entire run and then went to the buy side. I'm going to have to show it to you on a 30-second chart here. Opens, rallies up, drops down, still. 15-second chart. There's the move right there. That's what it looked like. It opened, ran up. This candle, this big green candle here, didn't exist yet. But you can watch it where it opens. It trades up, creates that short-term high there. Then it runs for the sell side. And then all in the same 1 minute candle, it opens here on this 15-second candle and then runs for the buy side. Then now we're hanging around in here. So I think we could make a potential run higher to take out this high. This run down here looks a little aggressive. It feels like they went down there fastest. And then this movement here, this is a lot of that run, break, retest, go short. I think traders are trying to go short from the retail perspective. And they would want to reach up into this wick here. I would observe and study with that idea in mind. So here's the level I'm referring to, 44.07 and then 44.05 even. That's the midpoint of this gap here. Okay, so watch and see if it wants to draw up into that. The main takeaway, what I was saying was, even in this fast market move, the fair value gap I mentioned and the liquidity pools, it went to the fair value gap, then dropped to the sell side, then ran for the buy side. So the takeaway would be, even in that speed, okay, of within 1 minute, the very levels that I gave you, the algorithm referred to immediately. In a way, in a speed and a velocity that even I can't participate in it. So the takeaway is for you to see that they're even in this recklessness that looks like chaos and just carnage, it's still being controlled. But it's being controlled in a way where it's going to move a lot in a short span of time, but you're not being permitted to profit during it. Okay, there's the run into our consequent encroachment I mentioned, it would draw to. Now look at the reaction of that. Just that little move right there. That in itself is a high frequency trading algorithm entry that moves back and forth. There's algorithms that trade one-sided. They stay in a buy model for buys or going long. And there's other high frequency trading algorithms that trade on the sell side. It's a sell side model. So it's only going short when it's offering the opportunity to do so. And then you have a model, a high frequency trading algorithm that simply goes all over the place. The opening here, it trades down into that. And then we have a short-term high. It's broken to the upside. So now think for a moment. Your mindset is, I'm strapped in, I'm in the saddle, I'm only running for buy side. So the high frequency trading algorithm that you would be studying in this fractal, in this type of price action, would be only looking for longs or only looking for buys. Okay, and how could you use that? Well, what have I taught you? What were the signatures that you've understood so far about what price uses to go higher? You have to have a shift in market structure. Here, you have a swing high. It rallies through it on this candle right there. It runs higher. That's fine. But what does it leave? Small little inefficiency right there. And it just ran our target there. That's it. But that's it right there. That is all you need, folks. What you just watched me outline here. I told you the direction I favored. I told you what it was likely to do. And I'm using a 15-second chart. So a order block, okay, is a change in the state of delivery. Okay, it is not a zone. It is not every down close candle that is an order block. It is not an up close candle. Every single one is an order block. It is a frame of reference where a change in where price will be drawn to or from, that occurs here. Why am I using this down close candle and not this one over here? This one has the larger body. So it spent more time and recorded more time and duration at its extremes. That lowest close, that makes this an order block. This swing high that it's part of, when it trades above it here, that's a shift in market structure. So that means high frequency trading algorithms will trip to buy side, and they'll all be looking primarily for the largest leverage to be on this side of the marketplace. Now, the chaos high frequency trading algorithms that trade up and down all day long, they'll take this trade too, but they'll also take this short in this fair value gap here that trades to it and trade back down into this inefficiency and change in a state of delivery, which is that opening price. The opening price, fair value gap, how do you qualify a high probability order block? It will have my fair value gap. Not every down close candle is an order block. Not every down close candle with a fair value gap like this is a long. Wait, that's a contradiction. No, that's a refinement. I'm teaching you narrative, logic, framework. The fact that we had this idea here, what was the first side of liquidity taken at CPI? We opened here at 8:30. It opened, rallied up here, stopped short, and then went down below to take the buy side. I'm sorry, to take the sell side. So which side of the marketplace did the algorithm run to first? So you have what? A delivery to sell side first. So smart money, the folks that understand the algorithm, the folks that follow its lead, wait for this signature here. Because the first, that tells you the direction. Because they're going to run for sell side first. This is the reason why I told you I believe it's going to go up here. How did you know that, ICT? How did you know it's going to go higher? Why did you pick that? Why didn't it want to come back down to consequent encroachment of this wick? It doesn't need to go down to the consequent encroachment of this, because the narrative is it ran for sell side and then quickly repriced away from it. It does not need to come back down here before it goes up to the buy side. And how it delivers, listen folks, how it delivers price after the second pool of liquidity is engaged. Sell side was below here. I'll go back up to the higher time frames in a moment. For now, I have to outline all this. The sell side was taken first. That means the move will be likely prolonged and much more prominent to the buy side. That means it's going to go higher. It upsets the orders and sentiment by this drop down here. Then it runs for the buy side. It breaks lower, comes back up, and then creates a false shorting opportunity. It delivers a short run. Traders see that we're short. They're thinking, yeah, wow, I got 4 handles, 5 handles or so. I'm getting ready to take out that low down here. It's going to keep going for the rest of the day lower. Wrong. It only reprices to the opening price here at 8:30. Opening price trades down. Look at the bodies. They tell you the story. The wicks did the damage. The body stops right at the opening price at 8:30. The algorithm receives that as information, comes back down to it. There, it stops on a dime, turns around, creates your short-term shift in market structure there. Down close candle, bullish order block, separation here. Come back down into it, hit the order block, respect it, close in the inefficiency, time distortion. All of this movement here, as long as we're not breaking below the midpoint of this down close candle, everything's still a go. What I'm looking at is this range from this high of this candle down to that low. As long as these 2 candle reference points here have not been breached above or below, all this stuff in here, I'm ignoring every bit of it. I'm not looking at any fair value gap inside of that. I'm not looking at any kind of potential order block, because this range here, that's your dealing range, it will not be anything of any importance or significance unless it trades outside of that range. And because I'm telling you, and as I told you live here, I believe it's going to go higher and take out the high. The first draw is here, and the buy side above this high here. So all of these candles from this green candle right above my cursor, all the way until we get to this candle's high right there. So this candle all through till here means nothing to me. I'm not looking at any of those candles and having any respect of anything it's doing, because the return from this fair value gap here. Let me draw it out. The market rallies up into that inefficiency again and trades down, only to offer delivery to the order block, close the inefficiency, and then time is spent marking time. That's it. We're in 15-second candles. So it's just hanging around. What is it doing? What do you think's occurring inside of all these ranges in here? Between this candle's high and this candle's low, that's all one order block. What kind of order block? Propulsion block. Look at month 4 content on my YouTube channel. Because it's all of this price action from this candle below, my cursor, all the way over to here, all of these candles are inside of this. So my mindset in focus is inside this range. Everything is happening inside it. I could care less. Because my mind has already established what the algorithm is going to refer back to is this signature here I've coded. So all of this price action here is irrelevant. It's just marking time, where prices moved in that interval, the highest and the lowest in the beginning and the ending. That's all it's doing. But my mind as a trader and the analyst is I'm looking at inside this range here. I want to see this range maintain itself and then eventually break to the upside, which we get right there. Where does it draw to? Where I told you, here. And then what does it do? It stops and then consolidates. What's it doing? What is it doing, folks? Think. The order block, it trades down to it. It's spending time down here. But what do you think is occurring in here? The algorithm is allowing time for traders that are in the know, that are real smart money. They're not Wyckoff traders. They're not supply and demand guys. They're not Goldman Sachs guys. Okay? They don't know this stuff. I promise you, they don't know this. It's allowing them to get their orders in before the algorithm reprices. And then it goes to our first point of reference, which is the consequent encroachment of this wick here. Stops. And then spends time. What's it doing? Allowing them to build a larger position. What's the model? Where's price being drawn to? Higher. So it allows them to accumulate more longs. And then as it runs up, they're distributing all their initial entries in here. They're selling it some in here. And then new algorithm entries are in here, accumulating more. And as it runs up, they sell, and that provides liquidity. So there's this dance that's always occurring between inefficiencies and liquidity. Premium to discount, discount to premium. Always, that's what's occurring. So 1 minute. Here we have it. Opening price. We trade down to it here. We rally up. Consolidate around. What's it working in here on the 1 minute chart? Mean threshold. Rally. Consolidate. Allow smart money to accumulate more longs and displace into the upside. Now look what's occurring here. We're getting short-term highs. We run above it. Short-term high. Run above it. When it starts doing this, and you watch me do this many times, and I just did it again yesterday in my trade for ES. When it starts creating these short-term highs, every time it runs above that and you're long, high-frequency trading algorithms are dumping portions of their position above that. That's why I do it. Okay? I'm in there doing the same thing that these entities are told to do when they work with this algorithm. And if they're doing it because it's a purpose in mind. They're offset distribution. If they have accumulated long positions in here and in here, how do they exit? Short-term highs, they move away from it. Above that high is going to be buy side. Sell to this buy side. Creates a short-term high, retraces back down in, creates a short-term high. When it runs above it again, sell, offset, distribute. Offset their long positions and distribute them to willing buyers. Where are the willing buyers above market price? Every time you create a short-term high, somebody in there, some joker, okay, some clown out there believes that Elliott waves and animal patterns move the market around. They're in there trying to trade their little gimmicks, and they're trying to go short. So if they're going short, they're going to try to do what? They're going to use an order that they think is protective. A short position, they use a buy stop. Where are they going to place that buy stop? above the recent swing high. So using narrative, reading where price is going to go, why it should go there, when it will consolidate and pause. I've taught you that live today. I've literally sat down here with you and told you. Now, did I tell you exactly how to do it right before CPI? No, because I have to wait and see what it does. What does it leave? It leaves clues all the time, but I have to wait to see what it will run for. I can't call the high and the low of the day until midnight in New York. But if I'm doing analysis and I'm talking to someone, they say, hey, what do you think about this? And what do you think about that? If I don't have the reference points that's required at midnight, I can only talk about what I know based on the information that's being shown in the information that we have available at that time. When we have these high impact or medium impact drivers that come out in the marketplace, I have to wait for the potential for manual intervention. Manual intervention is here. We initially opened, ran above the fair value gap, then dropped for sell side. So think about what I taught you. We outlined real time before the market delivered where the liquidity would be and the inefficiency that would be utilized. It opened, ran up just above it. Let's go back down in the 15-second chart. Oops, I gotta change it by that. We opened, rallied above that fair value gap I outlined, then ran for the sell side. Then it ripped higher for the buy side. The fact that it ran to the fair value gap here, then to the sell side, in itself, if it was not a high impact news driver like this, that type of run would have happened over the morning session. And a later run in the afternoon would have been this move here to the buy side. But because of the removal of liquidity, believe me, there are people that want to trade this. But brokers and liquidity providers, they pull access away from the marketplace. That's intervention. That's manipulation. But after the fact, how we traded, what was the first pool of liquidity that was ran? The sell side. Now think about if you were long, or any trader that was long, if this report ran down and hit that stop loss, would you be willing to get back in to go long? Be honest now. Chances are, no, you wouldn't. And that's why they do it. They run for the liquidity on the side that they don't want to want. Oh, no, let me say it right. They run for the liquidity first on the side that they want to make sure they scare out of entering and being on the right side. So it's the first run on liquidity on medium or high impact news drivers that tends to be the side that would be the winning side if they wait. Then you see the buy side taken after. But you have to wait. You have to wait. What does it want to do? It pulls back inside the range. What range? Between the two pools of liquidity. That's this line here and this line here. Let me thicken them up. Okay, so these two reference points, that's your range. Okay, so after it took the sell side out and then the buy side, it pulled back into the range. Now, both of those pools of liquidity define a very specific range for liquidity purposes. We outlined buy side was above here and sell side was below here. The algorithm knows both those points of reference, just like I showed it to you live before it was being used. Where'd it go to? Consequent encroachment, right in the middle. Range low, range high, liquidity above it, liquidity below it. Pulls back to consequent encroachment. The bias I gave you is going higher. What did it reach for? The first draw here, and then we wait. Does it want to take the buy side here? Then we went into high, high, high. What'd I tell you? Offset distribution. Algorithm starts selling and offsetting their long position. At every time it takes out a high, they're doing that distribution. They're selling to those buy stops. What did it do after that? We're off the highs. On a 1 minute chart. In all this business, notice that this wick here, I went inside of the range between that high and that close with that 15-second chart. So you might have a measurement of consequent encroachment on this wick here. That's fine, but in this wick, I want to be in the lower time frame, very, very small time frames. And I just showed you precision with 15-second charts. Smart money distributed. Real time, I was explaining it to you. And look where we're drawing down to the high end of that buy side liquidity pool. That's this over here. And the lows are over here. Okay, down close candle, gap. So far, we're expecting that. To see how, if we get up into this area here, do we get above it and treat it as support? And let's go up to a daily chart. Weekly. And we have a little bit of ways to go to get up into that inefficiency there. Initially, we have worked into this high. So there was buy side here. So that's what we're looking at also on how the market was reaching into those short-term highs. And I was telling you that's how smart money also distributes their position when they're long. So look at this high here, okay? I'm going to make this purple because I think we got other colors on the lower time frame, or maybe I deleted it, I don't recall, but let's go back down to 1 minute chart. Yeah, deleted it. That purple line here is that weekly or daily chart high. We went above it. And as soon as we went above that, we're in kind of like an area of, the word escapes me, I can't think of what I'm trying to say, but we're above that high where liquidity, how far do you see it reach? On the daily chart, let's go back up to it real quick. Or weekly rather. This high here, the next important level above here is inside of this inefficiency right there. Okay, so we have consequent encroachment about mid. Well, let's just get the measurements. Might as well do it right. If you're going to do it right. So 44.28. Okay, so 44.28 is consequent encroachment. And again, I'll just throw this in here because invariably I know some of you are like, can you show me your fib settings? It's the first time I watched your video. And that's an extension, so we'll take that off. And that's an extension. Okay, so there's your ICT fib settings. Rewind the video if you want to see it again. So consequent encroachment is midpoint, and that's above this high here. So buy side that would rest above here, so buy stops. Who would have a buy stop above that? Long-term hedge fund traders, big, large funds. Right in here, 44.28. Okay, that's the midpoint of this candle's low and this candle's high. And that inefficiency here is a fair value gap. What kind of fair value gap? SIBI, sell side imbalance, buy side inefficiency. Meaning that if the market were to efficiently reprice to this, it would be doing it with a run higher. We only had one pass through on the downside with this candle here between this candle's low and this candle's high. We have a partial run into it here. But we now have exposure still with inefficiency between this candle's low and this candle's high. So what I'm saying is if we look at it like this, that's the only real, at this moment, inefficiency that resides in that old gap between here and here, but not a zone. I look at very specific price levels. The 50% level of this inefficiency here, that is consequent encroachment at 44.28. So that's a real level. It's not some range. It's a very specific level. Now, because we have this range between this high and this candle's low that's shaded in blue, I would do the same thing with that, so that we would have a consequent encroachment level of 44.41. So I have 44.41 is a key level to the upside, and 44.28. They should be on your charts. How you note them is your business. I have it written in my notes. It's just a piece of paper that key levels, I have notations of what time frame they're anchored to. That's it. So me showing you that, it would mean nothing to you. But showing you in a chart like this and teaching it, I'm already always teaching the levels that I'm interested in anyway, every time I'm doing analysis or whatever. But that's how I'm referring to upside and where it might draw to. But we just poked our head above this old high, and then let's go back down to that 1 minute chart. Remember, I was counseling you to look at how we were going higher, higher, and higher. Smart money that went long in here and down in here, they would be selling their long positions above this high, and that's how you get your three drives high formation. Okay, which is retail pattern. It's wonderful, but how do you know when it forms? Everything I've outlined here this morning. I told you and brought your attention to it right when it was forming. Is that cherry picked? I'll leave that up to you to decide. So I would like to see how we behave at this gap right here. Do we go through it like a hot knife through butter and go into this buy side, or do we run above it, come back down and act as support, and then run, which a little bit more sustained run could manifest itself if it did it that way. So we had, what was it at, 5 minute? Yeah. So we had our 5 minute gap. I told you, watch that there. Went higher, but inside this range of this wick. Okay, let's go through that. 4 minute, 3 minute, 2 minute, 1 minute. Did you notice how the bodies, except for the 4 minute, look at it again. Here's 1 minute. Look where the bodies were. Were they going inside the fair value gap? No, just the wick were. How about the 2 minute? Look where the bodies were. The wicks went down to offer what? The inefficiency that was in here. What is it inefficient? Sell side delivery. It's a buy side imbalance, sell side inefficiency. BISI. It is a fair value gap by classification, but specifics, it's a buy side imbalance, sell side inefficiency, meaning that it will likely need to drop into that. Again, offering, repricing. Once we leave that range, it becomes what? It's a balanced price range. Let's go into 3 minute. Look where the body stopped here. In 4 minute. See what's happening there? The wicks are doing damage, but it's offering the sell side, but the wicks and bodies are not both inside that fair value gap. So what is it telling you? It's likely to go higher, which is why I told you I would like to see how it trades to this, and if it goes above it, eventually the draw on here is what we're looking for, but if it goes above it here but falls short of this high, does it act as support? So we didn't get a return back in to offer a support, which would have been a nice little area to study for entry, but we did get the fair value gap I mentioned here. Let's go up into a 5 minute chart. So now how far can it go, ICT? When I have these types of runs, what I like to use the fib for, I'll take the fib, anchor it to the low, draw it up to this high, and then pull up the extensions. Okay, this will be first partial, assuming that you would, like if you were looking at price action, whether you back test it and it's already happened, like when you go to work and come home later on, you're watching this video, or if you were at school, or if you're waking up and you were sleeping while it's being live, you go back through the data like this and you look at the price swings like this, you measure it 1/2 of one standard deviation. or negative 0.5, that's always going to be a partial. No matter how you trade, if it's this time frame or another, if you have an extension that offers you profitability, I don't care if it's not even 5 handles, you have to learn to take something there when you're first brand new at learning how to do this. And measuring when it doesn't reach it. How often does it not reach it versus how many times it does? And then what you're seeing here was -1 standard deviation, which is really the measured move of this low up to this high added to this high projected up. So in other words, if you were to take this movement from here to here, duplicate it from this high projected up, that's what this negative standard deviation of 1 is. So it's a perfect measured move. I like to look at how we have traded also. So let's assume for the moment and play devil's advocate that we were long in here and we rallied up and we took partials here and we wanted to trade the daily range, not trade the session. When I'm doing my examples, I'm teaching you how to trade that particular session. So I'm moving my stop up to protect the open profits for that particular session, which is what you watched me do yesterday and you see me do in last Thursday's example. So I showed you both of those positions. Working what? The long side. Why? Because my higher time frame analysis that I've been sharing with you has been calling ES higher. Why? Because it's going to trade in sympathy to NASDAQ. So by having this outlined experience where we know that the market is likely to draw on these higher time frame premium arrays, that means it's going to go up. How do I engage with it? Well, how do I teach you? First, start looking for one good setup per week. Just find one good setup, not an everyday setup. Because if you can find a setup that you can find once a week, that same model, that same approach that you use for that one setup that you've been waiting for one period of trading inside of an entire week, you're going to forge discipline, self-control. You will get your ends met by that. And because you're getting experience with it, you can take that and reduce it to a smaller time frame, and you can find more of that same model in formation across the entire spectrum of the week. Silver bullets exist in many runs, but I just gave you a very specific time when they form every day. But unless you know where the market's going to go, it's highly unlikely that you're going to be consistent with it, because you're just going to be guessing. And you're going to look at every little separation between 3 candles and think it's a fair value gap that it's an entry on, and it's not. You still have to know where the market's likely to go to. Now, devil's advocate, say we were long and it wasn't a CPI day. It was just a normal every run-of-the-mill day, and we went long and everything behaved as we see here. We were taking partials here. We were taking majority of our trade off in here. The stop would have remained below the opening price at 8:30. When the market started making its run, let's go back into a 1-minute chart. Here's your 8:30 opening price. You would still have your stop, or it would be below this opening price initially. Get this scrubbed up here a little bit. This wick, consequent encroachment, would be in here. Your stop would have to be below that. But ICT earlier, you said it doesn't need to go down. It doesn't need to go down there, but it can revisit the consequent encroachment. It can. 8:30 is when the news embargo lifts. That means there's going to be volatility. It's going to get up and down. Not to this magnitude, because CPI is a little bit more aggressive. Think of it like non-farm payroll. It can be a little bit more wild, or more animated. So, or if you want to be very conservative, your stop loss, again, you're trading for the daily range. So that means you're not trying to do your 30 contracts, your 40 contracts max position. Okay, you're trying to trade the daily range, where you're trying to maximize the availability of the full daily range. Your stop could be placed below here, minimum consequent encroachment. So let's give you the specifics on that. So stop loss would have to be below 43.88 and a quarter, which is so close in proximity to 43.87 and a quarter, which is the low end where I told you the sell side liquidity resided. which is relative equal lows here. And the, not that one, sorry. Here. And again, I mentioned the buy side here. So we've already worked that sell side. So how do you place your stop loss and feel confident that it's not going to hit it and knock you out? If you're trying to day trade. Day trading is position trading for the daily range. Intraday scalping is session trading. That means you're trading the morning session before lunch in New York and in the PM session. There's a distinction there. When I say day trading, what I'm saying is you're trying to capitalize on the majority of the daily full run from open to close. You're trying to get the lion's portion of that move. That's not scalping, that's day trading. Scalping or intraday scalping or session trading is where you're getting in and out, typically many times within the same hour or so or 2 hours. How do you trade that ICT versus when you're teaching us recently in the last year or so? When I'm doing my examples, I'm teaching you how to operate inside of the session, whether it be the morning session or an afternoon session, whatever one I'm trading in at the time. I'm capitalizing the move that I foresee that would be just the lion's portion of that specific session of the day, whether it be London session, New York session, or New York PM session. Whatever it is I'm trading, it's relative to that specific session. If you want to capture larger runs on price, then you're going to leave your stop loss, which I know some of you don't like that. It makes it terribly fearful that leaving a stop loss while the market's running all the way up here and up here, your stop loss would still be below the opening, because you won't learn how to place stops and move stops effectively in the beginning by trying to move them tight. So as a day trader, you could be still long. Your stop loss will be below the low end of that dealing range where sell side was already tagged. Lion's portion of the move would be off here, and you would have taken partials above this high here as well. You would not, as a day trader, put your stop loss below that low. Why? What do I teach you about the lunch hour? Lunch hour macro runs on liquidity. What liquidity? The stops that would favor the folks that have been profitable all morning long going into New York lunch, they have trailed their stop loss because they don't want to lose open profit, when really they're guaranteeing no potential further open profit, because the market will, in fact, many times go down and take out the low of the day that was formed prior to 11 or noon New York local time. They'll take those stops. When does it occur? Between 12 o'clock New York local time and 1:30 New York local time. You can go into your old price moves and start studying it with the things and reference points that I gave you. I outlined it live for you. I told you where the liquidity on both sides would be. I told you the framework with the fair value gap. I mentioned that we would watch this one here. We're bullish. Okay, I didn't say we're topping. It just means that we're looking for the 9:30 opening. Okay, what is it going to run for? And I told you I want to see how it behaves at this fair value gap when we're down in here. And we would want to see it run for the buy side, which it did. The longer term draw, 44.28, I think the first one was. Okay, so that's consequent encroachment of the old weekly CPI. Okay, so have that on your charts, 44.28, and treat that going forward into the rest of the week, and study how we deliver. If at all, it may not get up there this week. It doesn't have to do it this week, but I'm looking for it to graduate towards those levels that I've outlined on the weekly chart. Nothing says that we are making a high or that we've topped. Okay,